What is good, YouTube? It is your boy Sam, and I am back with another video. Okay, this is like day number 6 in a row. We're on a roll, and I will continue to bring you guys, some good knowledge and some bangers. So make sure you guessed it, like, comment, subscribe, and share this video. Okay. So today we will be talking about cost basis. Another way of saying it is your cost average. If you don't know what that is, I kind of mentioned it in some previous videos. If you have not seen that yet, make sure you go back and look at the other videos. It's not necessarily a prerequisite of this video, but it's just kind of a nice order right now. Okay, and if you gotta pause this video, rewind this video, and watch this video multiple times, that's perfectly fine too. This is not something you're expected to get as soon as you watch it, one time go around. So even if you're watching this with a peer and they get it before you do, they may have a better fundamental knowledge or more experience trading stocks than you do. So don't panic. This is why we're here, right? So when we say cost average, if you noticed in a previous video, I mentioned buying the dip, right? So if you're already in a position and the stock is not doing well due to whatever reason, whether that's just the pattern or economic news, what have you, right? You shouldn't panic. You should always make sure you stay calm, evaluate the market, and buy more if you need to. Okay, if you buy more, that is what I call cost basis or cost averaging. Okay, and that just basically means that the average price that you have most of your shares at, that is the price that you essentially need to be above to be in the green. Okay, now what does that mean? I'll give you some examples. Let's say you purchase one share of Apple at $100. That's the example I've been using, and I think I'm going to stick with that. So, I decide something new. Okay, this is not a Apple promo, by the way, but it's just a very popular stock that a lot of traders like to use, and so we're going to use that blue chip company, Apple, right? You're trading one share, or you own one share at $100. Your cost average is $100. Easy, makes sense, right? If not, maybe this will help you out. If you buy 2 shares of Apple at $100, what do you think your cost average is going to be? You guessed it, $100. All right, now let's spice this up a bit, okay? If you buy 1 share of Apple at $100, and you buy another share of Apple at, let's say, $50, what do you think your cost average is going to be? Some of you may have guessed it. Don't overthink it. It's simple. You average the two, right? 1 share you bought at $100, 1 share you bought at $50. You cost average that, that's going to be $75. What do we need to do? We're going to verify that. We're going to fact check it. All right. So let's go to the calculator here. You guys can see that, right? So 100 plus 50. 150 divided by 2. $75. You get it. Simple math, right? Now, cost average is not limited. When we talk about averages, obviously you're not limited to like 2 values, right? You could be buying, let's say, 50 shares at different prices. You're not expected to go in and calculate them, but when you see the cost basis or the cost average value and it's some weird number, that's what it is, essentially. And you know how they got that number by taking all of the values, dividing it by however many that you have, how many shares that you have, dividing it, equals, and then you get your cost average. So we're going to use a little more complex example here, right? So let's say you purchase 1 share at $100, 1 share at 50, so we're going to plus 50. And let's say another share at $68. That's 68. Get this value here, 218. Divide that by 3. and you get $72.66, give or take, right? So with that being said, you know that in order to be green, you need to be above $72.66. What that means also in translation, basically, if you bought 3 shares at $72.66, that is equal to you buying shares at those random prices. Now let me explain the importance of cost averaging, okay? So I like the first example I used with the share at $50 and a share at $100. But let's just say you purchase 1 share of Apple at $50 first, okay? But you think it's gonna go to $200, or you think it's gonna go up, you're feeling bullish about it, okay? And what happens is the stock tanks for whatever reason. Maybe the CEO said something, maybe there are world tensions going on that affect the price of the stock, and it doesn't go as planned. So now you have 1 share at $50. I'm sorry, you have 1 share at $100. The stock goes down to $50. So now you're down 50. You don't panic and sell it for a loss of $50. That is what most people do. These are the losers of the stock market. This is why, investors like myself, and soon to be yourself, are going to capitalize off of the mistakes of other retail traders. They panic. You do not want to panic, when things don't go your way, right? And we're going to talk about that in another video where we talk about, panic selling, emotional trading, revenge trading. These are all things you want to stay away from. And I'll tell you, right, how to, logically understand that and back you up emotionally. Because we are human beings, so we are emotional. You can never take out your emotions completely, but the more you understand it, the more you'll be able to control the emotions and be able to follow the trend to where, you're on the winning side of that fence, okay? So, back to the original example, right? So, you buy the stock at $100, it goes down to $50. So now you're down 50, but what you're gonna do, are you gonna sell it? No, you're not gonna sell it, right? Person A might sell it. Let's say you're person B. Person A might sell it, but you're person B. Person B, we're not gonna sell it. What we're gonna do is we are going to buy more. Okay, so we might buy 1 more share because you bought 1 share last time. You wanna keep it at the increments or somewhat increments to what you've been purchasing it at, right? Depending on how much, available buying power you may have. But for the sake of this conversation, let's say you have enough to purchase another share, which is why it's important that you never trade 100% of your portfolio, and not for those reasons only, but for many other reasons, which we'll talk about in future videos, which you subscribe, okay? But let's say you have that capital on standby, right? You have enough to buy another share of Apple that's just been waiting, right? So you purchase another share at $50, that brings your cost average to $75, right? You can know why, because of the example I gave you before. See, you guys will become natural, okay? And now, let's say Apple is still at $50. Instead of going back to $100 for you to be in the green, for you to make that 50 back, all you need is for Apple to just go up to $75 for you to break even, or $76 for you to be in the green, right? Versus your old self when you made that initial purchase. If you were up, if the stock went up to $76, right, and you just held on to that 1 share, there's nothing wrong with hanging on, but you hung on to that 1 share, you didn't purchase another share, right? You would still be down. You'd be down $24 before that $76, right? But now, with your cost average at $75, you're in the green. Okay, so that is the importance of cost average. Okay, if you guys don't get it, we can also do other examples. This can be very important and very useful, especially if you have a lot of capital deployed in these companies already. Okay, and what you might notice is, let's say you have, and this is a pretty large scale, right? So we can get there one day, okay? But let's say you have 100 shares of Apple, okay? You buy 100 shares of Apple at $100, so your cost average is $100. If you decided that you were going to, buy 1 share of Apple at $50. Let's say the stock went to $50. One share of Apple at $50. Do you think your cost average would come back down to $75? No. It would probably take you, well, it would take you exactly 100 other shares to be purchased at $50 to bring that cost average down to $75. Okay? And I'll show you a visual representation of that so you can better understand. I'm sure that makes sense to a lot of you, but you know, this will give you an opportunity to better focus in, right? So let's just say 100 shares, right? At $100, you don't need to do math that. So average is 100, right? So now let's take, actually do this last here. Yeah, so pretty much, right? So let's take 100 shares times $100 equals that, and then you add, let's say, $50 to that other share, right? And then you divide this by 101, because you have 101 shares now. Does that equal? So it brought your cost average down 50 cents, okay? So you originally had 100 shares of Apple at $100. It came all the way down to $50. You purchased one share at $50. Now your cost average is $99.50, which means instead of it going all the way back to $100 for you to break even, it just needs to come up to $99.50. So that's 50 cents less. Now, I know you might be saying, well, that's not much of a difference at all. However, this is a good strategy to bring that cost average down. So as bad news continues to happen, right, and the market is bearish and you don't know when it's going to stop, let's say you did have enough capital to purchase 50, or 100 shares of Apple at $50. You don't want to just jump into it and do that, right? You want to basically break it down in increments where you can do 10 shares at $50, 10 shares at $49, 10 shares at $48, 10 shares at $47. So that way, if the market does go down, which we don't want it to, but we know how to capitalize if it does go down. If it continues to go down, you'll basically be buying in at the lower increments, right? All the way until it doesn't go down anymore. And once it starts shooting up, you will be in the green. You'll be making a lot more money. So that's actually a good strategy. So like I said before, right? I like when stocks go down. I'm not telling you guys to, but I capitalize for those. Those are when I look at things like they're on a discount, okay? So that pretty much wraps up this lesson. I hope you guys understood that, right? Make sure you guys leave in the comment section what you guys want to talk about next. Next we'll talk about maybe, market orders, limit orders. We'll see. But make sure you like, comment, subscribe, and share the video.